Welcome to the first edition of our LOI Market Briefing. My name is Oliver Sparring. I am head of trading at TradeNeon and I warmly welcome you all. In the future, we will look at the S&P 500 together every Monday before the US trading session begins. We will of course discuss our level of interest levels, but we will also look at various data, determine whether institutional trading interest lies in the market and what news awaits us during the week. Let's jump right over to the 5-minute chart. We'll hide our LOI levels for now and focus on the dashed orange lines. These represent, on the one hand, the expected move for today's trading day, meaning from the 0 DTE range, and on the other hand, the expected move for the entire trading week through Friday. We also see this indicator here, which shows two solid lines. The solid lines represent the calculated expected move. For this, our self-programmed indicator uses the Black-Scholes formula to essentially calculate the theoretical price of the 0 DTE straddle based on the yesterday's 4 p.m. closing price. The dashed orange line, however, shows the actual price of the straddle at that point in time. For anyone unfamiliar with the term straddle, it is simply the combined price of the at-the-money calls and puts at that point in time and for the respective expiration date. Through this price, we can essentially determine what volatility is priced into the options markets for the respective time period. From this, we can draw two important conclusions. First, these zones represent important resistance and support levels. Second, we can generally determine how much volatility institutions and market participants currently attribute to the respective market. As you can see, the dashed orange lines are currently inside the solid lines, so we will presumably be dealing with a rather quiet day today, since the actual expected move is smaller than the one calculated based on Black-Scholes. It is therefore relatively unlikely today that the price will run far above the high of yesterday's cash session. What is also notable is that the light orange line up here sits at the previous day's high. So it cannot be assumed that over the course of the entire trading week, we will move beyond the high of last Friday's electronic session. This can, of course, change quickly if any new news hits the market that we cannot anticipate at this point. You know, we live in turbulent times, and any day a new piece of news can come around the corner that throws the entire market structure into extreme turmoil. Both the 0 DTE expected move and the weekly expected move are, however, relatively low, so we can expect a quiet trading week ahead of Easter. Speaking of Easter, Friday is Good Friday and therefore a market holiday. Accordingly, we can all take Friday off and dedicate ourselves a little to egg hunting. And cake and chocolate should not be neglected either. Today at 10:30 a.m. EST, Jerome Powell from the Fed is giving a speech. This is the only news we need to pay attention to today. Otherwise, we have clear sailing in the day trading context. Let's now take a look at the chart and our level of interest levels. As you can see, the market opened today with a small gap to the downside and initially accumulated volume in these price areas. We are currently between the 6,360 and 6,470 and in a Vanna bear zone. However, this was already tested at its lower boundary at the beginning of the session. Those who follow our content closely know that once a Vanna zone has been completely traversed, a kind of rubber band effect occurs. It is not uncommon for the price to run through the entire zone in the opposite direction during the same session. In this case, we really had a pinpoint landing at the 6,360. The market then reacted once more exactly to the previous day's low, but has since cleared a multitude of levels and is rising strongly. However, I would not stir up too much optimism at this point. We have the upper span interval of the day up here at 6,460. From a statistical perspective, when the price already reaches the span interval on one side or the other during the pre-session, we frequently see a strong move in the opposite direction during the cash session. This does not mean, of course, that this necessarily has to happen today. However, Should we see a reaction to the span interval before market open at 9:30 a.m. EST? I consider it likely that the market will tend to be sold off during the cash session. The high uncertainty and tension regarding the war in Iran naturally contribute additionally to making a strong rise in the stock markets over the next few days seem rather unlikely. As long as the market does not show us otherwise, we would therefore use our levels to tend to look for short entries. A good opportunity would be, for example, the level here at 6,450 points, since below that we have plenty of room down to 6,420 and can therefore expect a very rewarding potential risk-reward ratio. In the area between 6,420 and 6,390, on the other hand, we have relatively many levels, so choppy movements and little volatility are to be expected here. These levels are therefore significantly less suitable for entries, since we must expect headwind in our direction immediately after entering the trade. I would only become truly bullish if the expected move is clearly broken and the price stabilizes above 6,477. But remember, choosing entries simply via limit orders at the levels and then hoping for the best never makes sense. With our market analysis, we always only want to clarify where and in which direction we want to trade. However, we always find confirmation only from the order flow. As soon as the market moves into an area or a level that is relevant to us, we look with a magnifying glass into the order book and observe how market participants interact with each other. Only when a suitable and statistically evaluated setup emerges do we want to click buy or sell. The currently most important selling anchored VWAP is running at approximately 6,540 points. As long as the price stays below this, the sellers clearly hold the scepter and control the trend. We should therefore not display too much optimism today. Let's take one more quick look at Volan and the dealer hedging data. Approximately $12 billion in delta need to be neutralized by the option dealers today by selling that amount. It is important that you understand that at this point we do not know how much of that has already been done and processed. Fundamentally, however, this number naturally has a negative bearish influence on the market. The picture is confirmed when we take a look at Vanna. We have some negative exposure in the 0 DTE range directly above the price and positive Vanna exposure below. This corresponds to a continuous area of negative exposure in gamma. In this zone, we are dealing with a lot of volatility and a rather bearish hedging effect by the market makers in the option markets. Only above 6,430 points in the SPX would we enter a bull zone and get more stable prices there. However, as of now, we are still somewhat distant from that. At 6,475 and 6,500 points, we also have two large negative exposure bars in the weekly Vanna. These are magnets on the one hand, but on the other hand, also strong resistance levels that somewhat represent the pivot points of the coming days. The market will have difficulty breaking these levels. On the other side, with the 6,250, we also have a strong negative Vanna bar on the downside that provides us with support. The chance that we completely collapse and the market heads into the 5,000 range is initially to be assessed as very unlikely for this week. If you would like to try the software Volan and want to benefit from the dealer data by yourself, then you can find our discount code for the Volan platform in the description. Also, you can test level of interest for 7 days free of charge as usual and find further information on our own homepage, TradeNeon.com. I hope you enjoyed our short market analysis and wish you a successful trading week, but above all, happy Easter, and I look forward to the next time.